Most people think wealth is built in the easy years. They think it is built when the market is calm, when the headlines are friendly, when assets rise together, and when success feels so smooth that it can be mistaken for genius. That has never been my experience. The most important fortunes I have seen were built in periods that felt uncomfortable while they were happening. They were built when one group of owners was being forced to sell for reasons that had nothing to do with long-term value, when one old industry was suddenly repriced by a structural shift the public had not yet accepted, and when a new wave of innovation started attracting serious capital before the crowd knew how to tell the story. That is what I think we are looking at right now. I do not say that lightly. When I was younger, I believed the job was mostly to find the best business in the world, pay a fair price, and then sit still longer than the other fellow. There is a lot of truth in that. But over the years, I learned that there is another layer to successful investing. The business matters. The price matters. But the reason the price is where it is matters just as much. If an asset is falling because its future economics have genuinely deteriorated, then a lower price is not a gift. It is a warning. But if an asset is falling because the current owner is under pressure and must liquidate it whether he wants to or not, then you may be looking at something very different. You may be looking at a transfer. A great deal of money changes hands that way. Most people never see it because they spend their whole lives staring at the asset and almost no time studying the seller. That is a serious mistake. The market does not just discover truth. It also reflects distress, leverage, fear, timing mismatches, political shocks, and all the little humiliations that come with needing cash at the wrong moment. That is where I believe we are now. The average investor sees the current environment and concludes that everything is simply getting more dangerous. That is obvious enough. It is also not the most useful observation. The more useful questions are these: who is under pressure? What are they being forced to sell? Which industries suddenly benefit from price changes or shortages that others treat only as which sectors are quietly attracting institutional money before the crowd even notices the move? And which of those forces could matter enough to define the next decade for someone who is nearing retirement and does not have the luxury of wasting 5 years on a bad portfolio idea? Those are the questions I care about. The first opportunity I see comes from forced selling in gold and silver, and I understand why that sounds backward to many people. They were told that gold protects you when the world looks unstable. Then the instability arrives, and the price of gold falls instead of rising in a straight line. That rattles them because they did not really own a framework. They owned a catchphrase. I have never liked catchphrases. Gold is not a piece of folklore. It is an asset sitting inside a very real funding system. Countries need dollars. Banks need collateral. Funds need liquidity. Currencies must be defended. Reserves have to be mobilized. When stress appears, people do not always sell what they hate. They sell what they can. There is a very big difference between those two things. That difference is everything here. If a sovereign buyer spent years accumulating gold and then suddenly starts selling some of it during an oil shock, a currency squeeze, or a geopolitical cash need, I do not interpret that as a clean verdict on the long-term value of the asset. I ask a colder question: what changed in the seller's immediate needs? Did the seller stop believing in gold, or did the seller run into a problem that had to be financed? Now, that second explanation fits the evidence much better. I have seen many episodes where good assets became temporarily cheap because the owner had no choice. A great bond gets dumped because the fund has redemptions. A fine business trades at a foolish price because a leveraged holder gets a margin call. A scarce asset is liquidated because the owner needs dollars this week, not because the owner concluded the asset will be worth less 10 years from now. The crowd sees only the falling price and gets frightened. The disciplined investor studies the structure underneath the falling price and asks whether the thesis is damaged or the seller is simply trapped. That is the first rule: do not confuse a distressed seller with a broken asset. When I look at gold and silver right now, I see emergency liquidity behavior layered on top of a still, living long-term thesis. I do not see the long-term thesis dead. I see the temporary pain that often appears when countries, funds, and institutions are squeezed by funding pressures they cannot politely ignore. That kind of selling tells you a lot about the seller and less than people think about the metal. Silver makes the case even more interesting. Gold has a simpler role in the public imagination. It is money outside the system. Silver is trickier. It has a monetary history, but it also has industrial demand attached to it in a way that changes the story. Silver can be pulled down when precious metals are forced sold, but it still lives in a world of manufacturing demand, electronics, energy systems, and industrial use. That dual life matters. If you get a temporary liquidation event in a market that still has real industrial appetite underneath it, you have the conditions for a serious mispricing that gets my attention. I am not suggesting that every decline is worth buying. That would be childish. I am saying that the reason for the decline matters more than the decline itself. If I believed the world had suddenly discovered that gold and silver were permanently less useful, I would be much less interested. But if I believe the move is being driven by sovereign or institutional stress, then I become more interested, not less. That is how many of the best contrarian opportunities begin. The second opportunity sits in a place that respectable dinner parties do not like to talk about, and that is one of the reasons it may be attractive. It sits in coal. Now, I know exactly how that sounds. People have spent so long treating coal as yesterday's fuel, politically toxic and culturally untouchable, that many investors cannot evaluate it soberly anymore. They react to it morally before they react to it economically. I have no use for that approach. Markets are not referendums. They are systems of scarcity, substitution, and cash flow. If one energy source becomes expensive enough or constrained enough, another one becomes economically more relevant, whether polite opinion likes it or not. That is what I think is happening here. When oil stays high and natural gas markets tighten, coal does not need to become fashionable to become more valuable. It only needs to become cost effective and available at the exact moment utilities, manufacturers, and industrial systems need a reliable fallback. If power generation needs another fuel, if energy security becomes more urgent than public signaling, if steel production remains essential for infrastructure, shipping, defense, and heavy industry, then coal can re-enter the conversation very quickly, not because the world fell in love with it, but because the world still runs on physical realities. Physical realities always win in the end. I have never met an ideology that could generate electricity on command or make steel without inputs. That is the second rule. Do not mistake cultural disfavor for economic irrelevance. That mistake has cost investors a lot of money over the years. For a long stretch, capital starved coal, regulation, environmental pressure, institutional mandates, and the reputational cost of being associated with the industry all helped keep fresh investment away. But when you starve an industry of capital and supply, at the same time that part of the world rediscovers a need for what that industry produces, you create exactly the sort of imbalance investors should care about. Underinvestment plus renewed necessity is not a slogan. It is the beginning of a repricing mechanism. And this is not just a power generation story. The people who only look at fuel switching miss the steel dimension. And the steel dimension matters. Bridges, rail, ships, military equipment, heavy equipment, construction, industrial maintenance, all of it pulls on steel. And steel, despite everything modern finance likes to pretend about weightless digital wealth, is still one of the bones of civilization. If countries are reindustrializing, defending supply chains, rebuilding infrastructure, or preparing for a more fractured world, steel does not become less important. It becomes more important. That means the supply chain feeding steel deserves more attention than the crowd is giving it. That is where coal becomes more than an embarrassing old fuel. It becomes part of the industrial answer. I do not think the right response is to buy every company in the space and pray. Linked sectors are full of bad operators, poor capital allocators, over-leveraged balance sheets, and executives who manage to waste a windfall that should have made shareholders rich. Selectivity matters, management matters, debt matters, production discipline matters, politics matter. But the broad setup, in my view, has changed enough that investors still using last decade's map are going to be late, and being late in a repricing like this can be expensive. The third opportunity is altogether different in character. It is not about emergency selling and not about an old industry becoming useful again. It is about innovation money moving toward a future revenue gap before the public understands why the gap matters. That takes us to biotech. Let me be very clear. Biotech is not safe in the ordinary sense. It is not stable in the way a utility is stable. It is not simple in the way a toothpaste business is simple. Many individual biotech companies fail. Trials fail. Molecules disappoint. Timelines slip. Regulators delay. Dreams evaporate. Anyone entering the space casually because he heard it might be the next big thing is behaving foolishly. But none of that changes the structural setup I see. Large pharmaceutical companies live off patent-protected economics. When those protections begin to expire at scale, a hole opens in the future revenue stream. The hole is not philosophical. It is arithmetic. That is what makes it important. If a company knows a major block of cash flow is going to face generic competition over the next several years, it has only so many ways to answer that reality. It can build internally, which is uncertain and slow, or it can buy innovation. That is where biotech becomes so interesting. What many retail investors do not see is that a patent cliff is really a transfer of urgency from giant balance sheets to smaller innovative companies that may hold the next answer. Large incumbents do not suddenly become adventurous because they enjoy risk. They become acquisitive because they do not like revenue holes. That is the third rule. Urgency at the top of an industry often becomes value lower down the chain. In biotech, that value can show up in strange ways. Sometimes it appears in a broad improvement in funding for the most promising areas. Sometimes it appears in rising multiples for companies with relevant pipelines. Sometimes it appears in strategic partnerships. Quite often it appears in acquisitions at premiums that would have looked absurd a year earlier. That is why I do not only think about biotech as a science story, I think about it as an acquisition story, a capital allocation story, and a platform story. It becomes more compelling when you add the role of AI and computational tools in discovery and development. I have always found that when a new technology materially compresses cost or time in a high-value industry, capital does not arrive politely. It floods in, stumbles, overreaches, corrects, and then floods in again. But it comes. Drug discovery and development are precisely the sort of places where faster iteration, better screening, and more efficient development economics can make small organizations much more valuable than they used to be. If a leaner team can create something of enormous strategic importance, then the economics of the whole landscape begin to shift. That is the kind of shift I want to notice early, not when it is on the cover of a magazine before that. Now step back and look at the shape of what is in front of us. The first layer is a forced sale. Gold and silver are being pressured by sellers who need cash, not necessarily by owners who lost a strategic belief. The second layer is a structural repricing. Higher oil and gas stress make neglected energy substitutes and key industrial inputs more economically relevant than they were before. The third layer is innovation. Biotech is attracting serious money because the future revenue needs of large pharmaceutical players and the rising power of new discovery tools are colliding in the same place. Those are three very different forms of opportunity. Most people will miss them because they insist on having one feeling about the whole market. They either become bullish on everything or afraid of everything. That is a child's way of looking at an adult problem. Markets are not solved with one emotion. They are solved by separating the parts. I have seen many investors fail late in life because they could not do that. This matters especially for people approaching retirement. There comes a point in life when you no longer have endless time to recover from a decade of poor positioning. That does not mean you should become timid. It means you should become clearer. You should care more about asymmetry. You should care more about real cash flows, pricing power, mispricing born of forced sales, and sectors where institutional money is moving for reasons deeper than a weekly headline. That is where real compounding is preserved and sometimes accelerated. The average person hears a story like this and asks the wrong question. Which one should I go all in on? That is exactly the wrong question. I have never believed that intelligence in markets comes from moving all your chips onto one square, because the story intelligence comes from architecture. A sound portfolio needs ballast, opportunity, and optionality. Ballast keeps you from getting destroyed. Opportunity lets you benefit from mispricing. Optionality lets you act when the world changes again. If you believe precious metals are in a temporary forced selling window, you own them patiently and size them responsibly. If you believe coal and related energy linked assets are in a structural repricing, you own selected operators with discipline and respect for the cyclicality involved. If you believe biotech is entering an acquisition and innovation wave, you gain exposure in a way that matches your actual risk tolerance rather than your fantasy version of yourself. That is how adults behave. One of the things I have noticed about the very best investors is that they never confuse a good thesis with permission to be careless. A sound long-term idea can still be paired with a terrible vehicle. A compelling sector can still be full of awful companies. A temporary dislocation can last longer than the impatient investor expects. Timing is difficult. Position sizing matters, balance matters. The person who wants riches by Friday usually goes broke by Wednesday. I have no interest in that kind of theater. What I care about is whether the broad setup suggests that important money is moving before the explanation becomes popular. I think that is exactly what we are seeing. Precious metals look weaker on the screen than their long-term thesis justifies. Coal looks more economically important than polite opinion would like to admit. Biotech looks more strategically valuable than the broad market conversation currently reflects. Put those together and you have something rare. You have a moment where forced liquidation, structural change, and innovation capital are all operating at once. That does not happen every year. And when it does happen, it can define a decade for the people who understand what they are looking at. I want to say something else that I think is important. Many investors imagine that the big opportunities always come wrapped in clear labels. They do not. Usually they look messy, they look morally awkward, or analytically inconvenient, or too early, or not yet fully loved by the crowd. They require a person to think in cash flows instead of in slogans. They require a person to ask who is being forced to sell, who suddenly benefits from scarcity, and who needs to buy innovation whether the public is ready or not. That kind of thinking is uncommon. That is why it pays. The older I get, the less interested I am in glamorous narratives, and the more interested I am in durable economic logic. Durable logic is what survives when the market's mood changes. Precious metals still have scarcity, monetary relevance, and a reason to be reaccumulated after emergency sales end. Coal still has utility, substitutability, and industrial necessity when energy stress persists. Biotech still has strategic relevance when big pharmaceutical revenue streams face cliffs and new tools lower the cost of creating valuable intellectual property. Those are durable realities. The market can ignore them for a time. It cannot ignore them forever. That is why I think this may be the last big wealth opportunity before a great many people reach retirement, still standing in the obvious places, still owning the obvious stories, and still wondering why the best moves always seem to start before they become socially comfortable. They do. The market pays people for seeing the setup, while it is still awkward. I do not know what next week's tape will look like. I have never trusted anyone who talks that way with too much confidence, but I do know this. We are being offered three different kinds of opportunity at the same time. A forced selling window in precious metals, a structural repricing in coal and energy, linked necessity, an innovation and acquisition wave in biotech. I have been through enough cycles to know how unusual that is, and I have also seen enough people miss moments like this because they were waiting for the world to make them feel safer before they acted. The world never does that. If you wait for complete emotional comfort, you usually buy after the best part of the move. If you learn to think in layers, if you respect risk, if you build the structure instead of chasing the excitement, and if you can tell the difference between a broken thesis and a distressed seller, you give yourself a real chance. That is all I have ever tried to do. And in a moment like this, it is exactly what I would be doing again. Because it may be the most important one for anyone who has spent years building a retirement portfolio and is now wondering whether this moment is a threat or a gift. A lot of people think big wealth windows arrive with a trumpet. They expect some clear announcement from the market that now is the time. That is not how it works. The market does not ring a bell for the patient investor. It creates discomfort, contradiction, and confusion. One thing that should be rising is falling. One industry everyone dismissed begins to get repriced. One innovation area keeps attracting money in a market that feels hostile to risk. The signals do not line up into a neat television segment. They line up into a puzzle. That is why so few people benefit. The crowd wants clarity before it moves. The disciplined investor does the work while the picture is still incomplete. He does not need perfect comfort. He needs sufficient evidence and a structure that lets him act without destroying himself if he is early. That is what separates serious compounding from emotional reacting. If I were advising someone 10 years younger than me and 10 years away from retirement, I would tell him that the greatest danger is not that he misses a hot trade. The greatest danger is that he arrives at retirement with a portfolio built entirely out of consensus. Consensus large cap exposure, consensus stories, consensus timing, consensus comfort. Then a real shift appears, and he is too mentally rigid to move, because moving would require admitting that the obvious map was never enough. I have no interest in arriving at the late stage of life with that kind of rigidity. I would rather own some things the crowd currently misunderstands and be patient long enough for reality to do the explaining for me. That is how I think about this gold and silver setup. That is how I think about this coal repricing. That is how I think about this biotech wave. And that is how I think wealth is most often built in the years just before retirement. Not by gambling on one miracle, by recognizing one by one the unusual places where the future cash flows, strategic urgency, and temporary mispricing are all pointing in the same direction. When those three things line up, I pay very close attention. I think they are lining up now. And if they are, then what looks to most people like a chaotic and uncomfortable market may turn out to be the period that quietly determines who enters retirement with optionality, confidence, and compounding still on their side, and who enters it wishing they had recognized the window while it was still open. That is the sort of difference a single cycle can make, and once you understand that, you stop waiting for the crowd. You start preparing while the crowd is still confused.